Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So we're just going to do another velocity banking review for today. But before we get started, I actually have a confession, right? I hate stepping outside my house. And the reason I hate stepping outside my house is because every time I meet other people, I feel like they're not fully there. I feel like they're not fully present because they're stressed, they got a lot of things on their mind, and they're just not focused. You know what I mean? But I'm kind of like the exact opposite, especially when I'm in my own house, right? I got life on easy mode because I got a paid off mortgage under 3 years, and it's so easy that I have enough time to do spreadsheets every single day, right? People who are stressed, people who have a lot of debt, they don't, it's not that they don't have enough free time, it's just that the stress is kind of killing them, so they feel like they don't have enough free time to do the spreadsheets that I'm doing right now, right? But once you pay off debt, man, everything will be a walk in the park. And once you have enough time to do a spreadsheet like this every single day for velocity banking, you kind of know you made it, right? So we're just going to do another velocity banking review. In fact, it's just going to be something we had done previously. I always like doing high income scenarios because it's like, hey, aim high, right? But you also have fun when it's like, oh, you got only like a penny left over. Like, oh, can you get out of this bind? And you realize that with more and more income, even if you have less and less savings or cash flow, the possibilities are endless, right? It's just about like it's like you having a powerful water hose, which is your income, and you just got to direct it efficiently to put off the fires, right? Whereas you got a little bit of income, you know sometimes no matter what you do, like you can't put out the fires if the fire gets too big. You know what I'm saying? So here, this is a previous example we did of velocity banking, where we have maybe like a couple that makes $350,000 gross, one student loan, one med school loan, and then we just assume that we're starting with all of this debt at once, even though it's kind of unrealistic, right? Maybe some unrealistic assumptions, but it makes the demo easy to do. But yeah, so yeah, let's get to it. So, what is velocity banking? All it is a debt payoff strategy using a line of credit as your main operating account, right? Main operating account. So, the average American, the difference between the average American and what we call someone who does velocity banking is that the average American uses their checking account to pay for things, their checking account as their main operating account. Where someone does velocity banking, they use your line of credit. So, what is a line of credit? All it is a financial tool where you could borrow money, pay it back, and then use it over and over again. So, I don't know if you ever heard of a HELOC, but it's a home equity line of credit. So, if you own a home, you can offer your home equity as collateral, and then the bank will allow you to use it as in the kind of like the form of a credit card, right? You could either swipe it, you click on a bank's website, like the my past home equity line of credit, they actually gave me a card to swipe, kind of like a credit card, right? But this one, they don't. You just kind of, yeah, I don't even know if I have checkbook access, but I have online access, so I just click the website online, and then they're able to dump like 280 grand, no problem, right? I got a personal line of credit, so this one right here, right? And then, yeah, I got too much credit according to a business credit card application that I filled out, I think a week ago. It was like, we can't give you more credit. You got too much, and that's because I have over $527,000 in lines of credit. Now, here's the cool thing. Like, if you want more of an explanation in credit, I did do a live stream yesterday, Credit 101. So if you're interested in just hanging out and chilling out on live, it's just 99 cents a month. And we get to just kind of shoot the breeze and talk about whatever. But I did go more in detail into credit in live stream. So, but here's the rule that you should never forget, that banks don't lend money to people who need it, right? It's kind of like, so some people see these demonstrations like, well, who's going to get a line of credit? And I'm like, I don't know. Like, if you're in the situation, probably won't, because, what I'm trying to show you is that if you had this line of credit available and you crashed the car, you could probably save yourself. But it kind of like, driving without insurance and then getting into a car crash, hard to get insurance out right when, or like after you get the car crash, you didn't have it before, right? That's very tough situation. Okay, but if you get it before you need it, then much easier, kind of like the line of credit, because banks don't lend money to people who need it. Now, with this scenario, let's just assume that we got, I don't know, a line of credit for $200,000, right? Maybe we have enough equity that warrants a $200,000 home equity line of credit. So we're just going to say, whoopsie, this is probably okay. So maybe $200,000 limit, and then it doesn't matter what the interest rate is really. It's usually 8 to 10. Right now I have an 8% interest rate, but then like I got another line of credit at 10%, right? 10% in the beginning. In fact, my first home equity line of credit was like this, 10% variable, meaning that it kind of hovered around 10%. And then it was like starting at 15 grand limit 2 months after I bought my first home. And then I applied, reapplied with the same lender, and then I got like 51,000 or something like that. And I was like, sweet. Okay. And I had that for 2 years, and now I have 280,000 at 8%. And so that's sweet too. So home equity lines of credit, and I'll just assume for the demonstration, for this demonstration, we have $200,000. I will say 8%, right? You get these from a credit union, 8%. You get it from a bank, usually it hovers around 10%. And then by law, I don't think they can charge more than 18%. Okay, so here, let's just assume that we have the same income. Okay, and then here we don't have any savings. So remember the rule that you should save 3 to 6 months of savings. Okay, 3 to 6 months of savings is about, actually, it's 3 to 6 months of expenses is a lot, right? Because if your expense is 17 grand, how are you going to save 3 to 6 months? Kind of hard, right? And if we're just talking about general expenses, well, then our general expenses is 3,500, and then you multiply it by three, it'll be like 10 grand, which we could, I think, achieve 10 grand. But what we're going to do is the exact opposite of what most people do, which is not have any savings at all and throw all of our money into debt. All of it. Like all of it. Okay. So now let's go ahead and do this. Income minus expenses, right? Whoopsie. Wrong column. Wrong row. C2 minus C3. And then we're going to have something called cash flow. And then our last step is that we're going to throw some debt into the line of credit. Usually we start off with high interest credit cards and short-term loans like the buy now, pay laters, Klarna, and all that good stuff. I can't think of the other ones off the top of my head. Usually I just start off with I don't really do the buy now, pay laters in my demos, but I have seen them in real life, and it's crazy, dude. Like 1.5 year loan at 30% interest, $300 a month, and it's usually like a small amount. And so they're raking it in, right? They're raking it in because they're expecting that you're doing things the traditional way, and you need something, you just kind of have it be eaten up by or your cash flow eaten up by an extra loan. And it's a phenomenon called segregation of income. But we're going to talk about that today. All right, so now let's go ahead and move this $150,000 into that line of credit. No, 150. And again, we can afford these two credit cards because, again, we got a doctor and a lawyer, dual income, right, in the family. And then guess what? This turns to zero, this turns to zero, and now our cash flow is $8,400. Okay, and so what we do is we now put our entire paycheck into that line of credit and then expenses out of that line of credit, meaning that whenever we get the minimum payment for whatever this would be, we put the entire 21 grand into that line of credit as an overpayment, right? We don't just make the minimum payment. See, most newbies and amateurs, they get a line of credit and they just make the minimum payment, and not only the line of credit because they're just treating it like another credit card, but all of these other loans. So we're not doing that. We're putting all of our money into debt, okay? And then expenses out, and then we're taking out our cash flow, or I'm sorry, our cash flow is being used to reduce the balance of the line of credit, okay? So let's go ahead and do this, and we're gonna put our entire uh, get the next month's balance by getting the previous month's balance, previous month's interest, month zero, we're just assuming no interest, and then subtracting our cash flow, which is 8471.53. Okay, and then what we do is we take the interest, right? The interest is going to be based on the average daily balance, right? Average, multiply it by the interest rate, which is 0.8 or 0.8, right? And take a look at this. You might freak out. 11 grand of interest. Oh my goodness. And then you divide by 12 because it's always calculated monthly, not annually. And so it's like, well, that's not that bad. Right? $971 of interest, and you have $141,000 of credit card debt. Okay, so let's go ahead and do this, and then we just copy and paste it. And now in month 19, okay, month 19, well, blam, we got it paid off. And so now what we do is we just write right here, 19 months, 150K. So less than 2 years, you wiped out that 150K of debt. All right, that's pretty good, right? So now what do we do? Do we tackle on these student loans, auto loans, mortgages? Which one do we tackle on? Are we tackling on the lowest balance debt, the lowest the highest payment debt, right? We'll just take a look at this one. And the easiest way to figure out, especially got a ton of debts, and people have been sending me spreadsheets of like 20 something debts, is I like to use what I call the cash flow index, right? So I have this loan calculator right here, and then you put in like, the original balance, the term, and the interest rate. You can auto calculate the payment, right? Auto calculate the payment, and also auto calculate like the current balance, and then it'll also calculate what we call the cash flow index. And so what this is like a number, kind of think of as a ranking system. So ranking system, the lower the number, that's the one you want to pay off. And anything lower than 50, you're good to pay off. 50 or 100, it's like eh. And then over 100, you really want to pay off last. Okay, so let me go ahead and do that. So this is 19 months. So now this is like 19, 19, 19, 19, 19, right? And so you can see that the current cash flow index, which will decrease over time with loans because it's a formula of the statement balance divided by the monthly payment, and the balance will go down over time, but the monthly payment is fixed for an amortized loan, right? But you see these two, they're under 50. All this means is that if we pay this off, we get a lot of payment back in our cash flow, so we get a lot of bang for our buck. That's all this means, right? So let's go ahead and do this. So G2 plus G3, and then that's 78 grand. So now what we're going to do is we're going to move 78 grand into our line of credit, right? So we plus 78084.02, right? And then, okay, guess what? These two payments, actually, is this right? 2775.51? Something doesn't seem right. Um, Oh, I got these mixed up, but still the idea is still the same. So let me just do this. My bad. It should be this, and then it should be this. Let me just see if I did that right. 1776430375. So 776. Wait a minute. I'm like getting confused. No, this is right. So 03757643. 0375. Yep. Okay, I'm right. So I'm sorry, let me do this again. So I just mixed up the order because I put the auto loans first and then the student loan. But so yeah, now guess what happens with these auto loans? Oh, wow, these payments go to zero, right? These payments go to zero. Whoa. And now we're at 10 grand cash flow. So let's update our cash flow number right here. Okay. So we moved the debt here. Now let's go ahead and update this cash flow number. And then now this is going to be 10591.64. Whoa. Oh, yeah. Look at that. 27 months. So we paid off two auto loans, or we put our focus on paying off our two auto loans in about 8 months, right? So month 19 to month 27, we are good. So 27 months. All right. So 27 months. And then, so what is it? It's 150 plus 55 plus 54. So 259K. 259K. All right. And so now what we have is the two student loans, okay? So let's figure out what the updated cash flow indexes are in month 27. And let me just go here. So 27, 27, 27. These are now 0, 0, right? And then, yeah, so we see that these new cash flow indexes are in the 70s. Um, in real life, and I'll do this differently because I'm going to show you how I would do it. And did I screw up here? Oh, this should be $600,000, right? As you can see, I'm a little bit sloppy today, and I reused some of these sheets, but it's all good. So 600,000. It doesn't matter. It's not like I dealt, I'm dealing with the mortgage anyways. But what I'm saying is this, okay? So here, I definitely would not pay off the mortgage. And you see this cash flow index number, 225. Why? Because if I focus on paying off this mortgage, $571,000 first, I only get $2,500 in cash flow back. If I pay off the student loan, $206,000, I get even more cash flow. Okay, I even get more cash flow back. Okay, so it makes more sense to pay off these student loans than it does to make sense to pay off the mortgage here, right? Interest rate does affect it, but so does the term, and we always want to pay off the thing that is eating up all of our cash flow. And what I would do is, if the cash flow index are above 50, I would use this thing called the chunking method, which is just move pieces of the loan into the line of credit rather than the entire loan. Like, I'm okay doing with the auto loans because it was under 50, meaning that the payments sucked up a lot of the loan, and that's because the loan term is under 5 years. But as the loan term gets longer and longer, um, I probably want to put the whole thing into the line of credit, right? So, but for this demonstration today, I'm just going to do that. So let's just move this into that line of credit and see how long it takes to pay it off. So this is the law school loan. Whoever is the lawyer, they're lucky because they'll get their student loan paid off first, right? So let's go ahead and put that in 124178.1, right? And then now we got to update our cash flow number. So what's our cash flow number? Well, we moved the student loan, and now our cash flow number is 12 grand. Okay, so 12 grand. All right, so now let's do this. And okay, so now 294.86. Okay. And so now let's go ahead and do this. And we're going to do this, and we're going to see that in pretty much 3 years, right? 3 years, we paid off the loan from law school. Wow. So, like, a lot of people freak out about their law school loans. Is that crazy? I'm not. What am I freaking out for? I know this thing called velocity banking, and so if you're a couple that's a doctor and a lawyer, you have absolutely no excuse to freak out about anything. You know what I mean? Like, what's going on here? So month 37. So month 37 is when we paid off that law school loan. So 37 months. So this is going to be 150,000 divided by, no, not divided by, equals 259 plus 150. So that's 409K. Wow, 409K. Okay, so now we got to tackle the med school loan. So let's just go ahead and do that. And so it's going to be 37 months. So this is now 0, month 37, month 37. Okay, and then it's 188 grand. Okay, well, we can move that. So 188 grand into the line of credit, and then this will be plus 188,166.73. Okay, so now since we moved that med school loan into that line of credit, we get $2,775 back into our cash flow. So this is now going to be zero, and then now our cash flow is 15 grand. Okay, so now what we got to do is we got to update this number, and then just go right here. And what we're going to do is 507007.38. Okay, and then what we're going to do is we're going to copy and paste this and see how long it takes for us to get rid of that med school loan, right? And wablam, there we are. Debt free as a doctor now, right? So debt free as a doctor. And what now was that? 52 months? 52 months. 51 months. Okay. So 51 months. 51. And let's see how much debt that is. So it's 409 plus 250. So 659K. All right. So 51 months and 659K. That is awesome. How much is 51 months? How many years? 51 divided by 12. 4.25 years. And now the mortgage. Now the mortgage. Okay. So now it's 51 months. Okay. So this is now 0, and then this is now 51 months. And here's the thing with the mortgage. Okay. I would never put the mortgage into a line of credit. Look at this cash flow index. Look how high it is. Meaning that you put this thing in, this 3% loan into a line of credit, you're only getting $2,500 of cash flow back. And that's a no bueno. So luckily, I got this trusted velocity banking calculator to kind of demonstrate why it's a no bueno. But let me go ahead and pull it out. Give me one moment. Okay, so let's take a look at this velocity banking calculator provided by Renatus. And if you don't know what Renatus is, this is where I originally learned velocity banking from. Full disclosure, this YouTube channel is just a sales funnel for velocity banking, but because I don't really need money, I'm a pretty bad recruiter slash salesman for it. But let me go ahead and input the numbers. And so what is it? I think I put in everything correct. Let me just double check. Yeah, I think I did. Okay, so all we gotta do now is all I want to demonstrate is that you don't move this loan into an 8% line of credit. So it's 544069.11. Okay, now you might be thinking, oh my goodness, 3 years and $67,000 of interest that we pay. Look at all this interest that we save. Oh my goodness, so 3 years and then 67K of interest by doing a full replacement. And this calculator is smart enough to know when you're doing a full replacement, right? Like you have this loan balance is now completely gone, and then it just focuses on paying off this line of credit balance, right? This line of credit balance here, and then it just goes on and on and on and on and on and on and on, right? So the calculations are comparable to well, like so this is so much more detailed than I would do it because I'm pretty lazy, but it's telling you that yeah, it'll pay off in 3 years, but you're going to pay about $67,000 of interest. Okay, now let's go ahead and just do what we call chunking, which is just doing a small amount comparable to your monthly income. And the most important thing is not like this whole chunking thing. Is just when you're at this point, making sure you've maximized this cash flow amount. That's what matters. And the whole point, the reason why we do this is an easy way, okay? An easy way to help us pay off the loan without segregating our income. Without segregating our income. Because the reason, I think I looked it up in ChatGPT. ChatGPT says like some ridiculous number, less than, I don't know if it was like 5%, make an extra payment on their mortgage. And the reason why they can't do that is because they're afraid, fear, right? It's inconvenient. It's kind of like New Year's memberships for the gym, right? Like they'll think they'll do it and then they don't do it, right? But if we just put $22,000 chunks, small amount, look at this, 2.8 years and 24K or 20, yeah, I'll just say 20, yeah, 25 Well, let's say 25K, right? And it's like, whoa, you saved about $42,000 of interest by not replacing the mortgage with the line of credit. That's very interesting, right? And if you insist on getting a first lien home equity line of credit, just give that $42,000 of interest that you would have saved to me. You can burn your money, but I don't recommend it. But that's essentially what you're going to do. Yeah. so this other channel, the reason why this channel exists is so if you were thinking of doing a first lien HELOC, I probably saved you a lot of money, and so you probably owe me, right? It's called internet gratitude. Actually, I don't even know if that exists, but it's just me. I'm just joking. I'm just having fun, right? But I always make a joke like, hey, like if you did a first lien HELOC, right, you pay this much, but if you just did the chunking, you pay so much more less. So why would you not do the chunking or you know what I mean? I always like to call it chopping up your loan into pieces with the help of a line of credit. But yeah. So let me go back into my other spreadsheet. So 2.8 years. Okay, so 2.8 years. So the final payoff date is 51 months divided by 12 plus 2.8. All right, so that is 7.505 years. And we are how much in debt? So that will be 659 plus 600, and then that's going to be $1.25 million of debt. 1.25 million of debt. Whoa, we are so cool. I am so cool. I am awesome. And you are awesome for watching this video as well, right? So, yeah, so if I had $1.25 million of debt, I'm confident that I could get rid of it relatively easy. Like, no biggie, right? Now, here's something I just kind of want to show about myself. I practice what I preach. So if I have no money in my checking account, I make sure I have no money in my checking account from the in the beginning at the end, right? Because all of my money goes into debt immediately, which is the line of credit. I have so much credit, and here's the thing: banks know the game, right? They created the game. They don't want to lend money to people who need money, and so it's why it's important to learn how the credit game works. And I have no money, or I'm sorry, I don't have any money in my checking account, but they know I don't need their money. And then you take a look here. You know, investing in real estate. I got my first property in 2022 at a $100,000 discount, um, and I'm already at 50% equity position. Zillow says 330. The lender says I got $165,000 in loans, and because the tenant is essentially paying for this, I use my money and the tenant's money, and then now you got life on easy mode. And what's life on easy mode? You got enough free time to do spreadsheets about every single day, like right now. Now, eventually, in I think a few hours, I got to step outside my house, but that's going to be like the most stressful period of my day just because I'm surrounded by people who are not stress free or debt free or mortgage free, right? I'm not stressed, but their stress kind of latches onto me and then I get stressed, right? Here's the thing. I want everyone else to be debt free, right? Because when I step outside my house, I want people who are chill. I want people who are easy to hang out with. I want people who aren't stupid, right? There's a lot of stupid people out there. I'm going to be honest with you. Like, they make stupid decisions and they got big egos. Now, if you're debt free, you actually want to kind of be like me where you kind of play it down because you want to be like, hey, because everyone else is stressed. You just got to be like, I'm part of the matrix too, don't worry about it, right? But I'm really not. That's why I make these YouTube videos, just to kind of like not go insane that I am not part of the matrix. Okay. Okay, hopefully that made sense. All right, well, it's Korean Atlanta mentorship. Have a great day, everybody.